You're drowning in data but starving for clarity. You've got sales numbers, website analytics, social media metrics, email stats, but when someone asks you how your business is doing, you honestly don't know how to answer. You think you're doing okay, but what if you're not? What if something's quietly broken and you just can't see it? Here are the 5 numbers that actually tell you if your business is healthy or headed for trouble. And if you're not tracking all 5 of these, you're flying blind. So let's fix that right now. Look, I get it. You're tracking something. You probably check your sales every day. Maybe you look at your website traffic or your Instagram followers or your email open rates. But here's the thing. Most of those are vanity metrics. They make you feel productive, but they don't actually tell you if your business is making money or burning through it. And that's dangerous because by the time you realize something's wrong, you've already lost months or thousands of dollars that you can't get back. I spent 26 years helping business owners make sense of their numbers. And when someone comes to me saying, I don't know where to start with my data, I always start with these same 5 numbers. Because these aren't just nice to know, these are the fundamentals that prevent you from having a crash and burn scenario. In the next 10 minutes, you're going to learn what each of these 5 numbers actually measures, why it matters for your business survival, where to find it in your systems, and the red flags that tell you something's wrong. By the end, you'll know exactly what to track and, more importantly, why it matters. So let's dive in. I'm Rob Fernango, and for over 2.5 decades, I've been translating complex business data into strategies that actually work for real businesses. And here's what I've noticed. Most entrepreneurs are so focused on growing their business that they forget to check if it's actually healthy. There's an episode of The Office where Michael Scott starts his own paper company. He undercuts everyone on price, offers amazing personal service. Everything sounds great until his accountant sits him down and says, we need to raise prices. Michael says, but our low prices are what's keeping us in business. And his accountant delivers the brutal truth. Actually, your low prices are driving you out of business. Now, that's a TV show. But I see this exact scenario play out with real businesses all the time. Entrepreneurs get so focused on competitive pricing or getting customers in the door that they forget to check if they're actually making money. It's not funny when it's your business on the line. That's why we're starting here with the numbers that tell you the truth about your business health. All right, let's start with the obvious one, revenue. This is the total amount of money coming into your business from all sources. Sales, services, subscriptions, whatever you sell. Most entrepreneurs already track this, but you probably know your monthly revenue off the top of your head, and that's great. But here's where it gets more useful. You need to know your revenue by source. Not just, we made $10,000 this month, but we made $6,000 from our website, $3,000 from Amazon, and $1,000 from wholesale. Why does this matter? Because if one of those sources suddenly drops off, maybe your Amazon account gets suspended or your wholesale client cancels, you need to know immediately how big the impact is. So where do you find this? If you're using Shopify, WooCommerce, Square, or any e-commerce platform, this is usually on your main dashboard under Sales by Channel or Revenue by Source. If you're service-based, you might need to track this manually in a simple spreadsheet, Client A, Client B, your online course, etc. Or you might have the data in your time tracking or accounting software. What are the red flags to watch out for? If more than 50% of your revenue comes from a single source, you're vulnerable. One problem and half your business disappears. So start diversifying. All right, number 2, profit and profit margin. This is where a lot of entrepreneurs get in trouble because they confuse revenue with profit. Revenue is what you bring in, but profit is what you get to keep after all your expenses. And your profit margin is that profit as a percentage of revenue. So here's the formula. Profit equals revenue minus all expenses. And profit margin is the profit divided by revenue times 100, making it a percentage of revenue. Let's say you made $10,000 in revenue this month, but you spent $4,000 on product costs, $2,000 on ads, $1,500 on software and tools, and $1,000 on your salary. Your total expenses were $8,500. Your profit is $10,000 minus $8,500, which is $1,500. And your profit margin is $1,500 divided by 10,000, or 15%. Now, people always ask, What's a good profit margin? And the honest answer is it depends on your business model. A physical product business might have lower margins than a digital course. Wholesale has different margins than direct to consumer. But here's the real question you need to ask yourself. After paying all of your expenses, including paying yourself a fair salary, are you breaking even or doing better? Because if you're not at least breaking even after paying yourself, you don't have a business. You have an expensive hobby. So what are the red flags to watch for? If your profit margin is shrinking month over month, something's wrong. Either your costs are creeping up, your pricing is too low, or you're spending too much on customer acquisition. And we'll talk about that last one in a minute. So where are you going to find this? You might find this in your sales platform if it tracks the cost of goods sold, or in your accounting software. But chances are you'll need to calculate it yourself. Pull your revenue from your platform, pull your expenses from your accounting software or credit card statements, and do the math. It takes 10 minutes, so do it every month. All right, number 3, lead flow by channel. This is the number of new potential customers entering your world each month, and more importantly, where they're coming from. Are they finding you through Instagram, Google search, Facebook ads, or a podcast you were on? Maybe it's referrals from happy customers. You need to track this because lead flow is your early warning system for problems with customer acquisition cost, which we'll get to in a minute. But if lead flow from a particular channel starts dropping, your cost to acquire customers from that channel is about to spike. So let's say you normally get 100 leads per month from Instagram, and suddenly you're only getting 50. That means you're going to have to spend twice as much per lead to maintain the same number of customers, or you're going to need to find a new channel and do it fast. So where will you find this? Google Analytics will show you traffic sources. And if you're using lead magnets or opt-in forms, tools like Kit or MailChimp will show you where subscribers came from. If you're not tracking this automatically, start asking new customers, how'd you hear about us? Then put that in a spreadsheet. What are the red flags to watch for? If any channel that drives more than 20% of your leads suddenly drops by more than 30%, there's a potential problem. Either the platform changed, like an algorithm updated, or your content stopped working, or you stopped being consistent. You want to figure this out fast so you can adjust your marketing strategy accordingly. Number 4, conversion rates, and specifically conversion rates at each stage of your funnel. A conversion rate is just how many people took the action you wanted divided by how many people had the chance to take it. But here's what most people get wrong. They only look at the final conversion rate, like what percentage of website visitors bought something. And while that's useful, it doesn't always tell you where problems are when they happen. Let's say your funnel looks like this. You have 1,000 people visit your website, 100 opt into your email list, that's a 10% conversion rate. 50 open your sales email, that's a 50% open rate. 10 of those people click through to your offer, which is a 20% click rate, and 2 actually buy, which is a 20% purchase rate. Now, your overall conversion rate is 0.2%. 2 out of 1,000 visitors bought something. But look at each stage. Website to emails, pretty good, could be better. Email to open rate, good. Click-through rates, okay. Purchase rates, not bad. So where's the problem? Well, it's actually at the top where only 10% of visitors are joining your email list. If you fix that first, everything else improves. So here's a pro tip. When you're optimizing, start at the end of your funnel and work backwards. Why? Because if you improve the top of your funnel, like you get more people into your email list, but your sales conversions are still broken, you just wasted effort bringing in people who won't end up buying. If you fix the end first, you get more people who reach your offer to actually purchase. Then you can work on getting more people to your offer. Now, people always ask, what's a good conversion rate? And here's the truth. It depends. For cold traffic, people who've never heard of you, they might convert at 1 to 3%. Your email list, the people who already know you, they might convert at 5 to 10%. But honestly, it's not a competition. Your goal isn't to have the highest conversion rate. Your goal is to know your conversion rate and then work to improve it over time. Where will you find this? Well, Google Analytics can track some of this. Your email platform like Kit or MailChimp can show open and click rates. Your sales platform can show purchases. And so you might need to piece it together in a spreadsheet. The red flags to watch out for: if any stage of your funnel converts below 1%, something's seriously broken at that stage. Fix it before you move on. And finally, number 5, customer acquisition costs, or CAC. Now, this one's critical if you spend money on ads, lead generation, or any form of paid marketing. Customer acquisition cost is how much did you spend to get one new customer? Let's say you spent $500 in Facebook ads this month and you got 25 new customers. Your CAC is $500 divided by 25, which is $20 per customer. Now, here's the question you have to ask. Is that $20 sustainable? If your average order value is $50 and your profit margin is 30%, you're making $15 profit from each customer. But it cost you $20 to get them, so you just lost $5 on every single sale. This is the Michael Scott problem from The Office. You're making sales, you're busy, and everything feels like it's working, but you're slowly bleeding money with every transaction. Now, there are nuances here. If you have a subscription model where you take into account repeat customers, you might be okay losing a little money up front because they're going to buy again. And that gets into customer lifetime value, and we can talk about that in a future video. But at a bare minimum, you need to know, is my CAC higher than my average order value? If yes, you could be in trouble. You're going to have to either increase your prices, decrease your ad spend and find cheaper channels, improve your conversion rate so more of the leads you pay for are actually buying, or figure out how to get customers to buy more per order. So where are you going to find this? Pull your total marketing spend from your credit card or ad platforms and count how many new customers you get. Then divide your ad spend by how many customers you got and do this every month. What are the red flags to watch out for? If your CAC is creeping up month over month, maybe it was 15, then it was 20, now it's 25, your marketing is getting less efficient. Either ad costs are rising, your targeting is off, or your messaging isn't working anymore. Fix it before it kills your profitability. All right, so now you know the 5 numbers: revenue by source, profit and profit margin, lead flow by channel, conversion rates at each stage, and customer acquisition cost. Here's what I want you to do this month, not next quarter, not when you have time, this month. I want you to pick one of these 5 numbers that you're not currently tracking, just one. Find it and write it down. Put it in a spreadsheet or a note on your phone. Then track it every month. Set a reminder on your calendar, the first Monday of every month. Check this number and write it down. Now, if you have a high volume business with quick transactions, like if you're running a lot of daily sales with a short purchase cycle, then weekly tracking might make more sense for you. But for most business owners, monthly is a perfect starting point. It gives you enough data to see meaningful trends without getting lost in the day-to-day noise. Because here's the thing, you can't improve what you don't measure, and you can't make smart decisions when you're guessing. Most entrepreneurs I work with discover that once they start tracking even one of these numbers consistently, they find at least one insight they completely missed, something that's been costing them money without them even realizing it. Maybe it's a marketing channel that's way more expensive than they thought. Maybe it's a product that looks like a bestseller but actually has terrible margins. Maybe it's a funnel stage where half their leads are disappearing. You won't know until you look. So start with one, track it monthly, then come back and add another. Now, here's the thing. Knowing what to track is just the first step. The real question is, what do these numbers actually mean for your business? Because you can have all 5 of these numbers written down, tracked every month, and still not know if you're in good shape or heading for trouble. And that's where AI comes in. And that's exactly what I cover in my next video. I'm going to show you how to use AI to analyze these numbers and reveal insights you're completely missing. Things like, why is your revenue flat when your traffic is growing? Which products are quietly destroying your profit margins? Where are leads dropping off in your funnel and what's it costing you? But before we get there, I want to help you figure out where you are in your journey with AI in your business. That's why I created a quick quiz called Your AI Next Steps. It takes about 2 minutes and it'll help you identify what stage you're at with using AI for your business, what your biggest opportunity is right now to advance, and what specific skills to focus on first to take that next step. To take the quiz, just click the link in the description or go to f1analytics.com/yourAInextsteps. You'll get your results immediately, plus I'll send you some resources tailored to exactly where you are. Whether you're just getting started with AI or you're already using it but want to level up, this will point you in the right direction. And then, watch my next video where I show you how AI takes these 5 numbers and turns them into actionable insights that actually move your business forward. All right, so now you know the 5 numbers every business owner must track: revenue by source, profit and profit margin, lead flow, conversion rates, and customer acquisition cost. These aren't vanity metrics. These are the fundamentals that tell you if your business is healthy or headed for trouble. If this was helpful, hit that like button so more entrepreneurs can find it. And if you're not subscribed yet, go ahead and subscribe. I publish videos every week on using AI for business analytics and automation, not just content creation. Next up, I'm going to show you the 5 questions you should ask AI about these numbers that reveal insights you're completely missing. It's called Why Your Business Numbers Aren't Growing: What AI Reveals That Dashboards Can't. You've got the foundation now, so let's build on it. I'll see you in the next video.